Hi, I'm Raz. This is Daniel.
Hello.
We're with Higher Financial Group. Daniel is a tax attorney, and we help people with retirement money. So we've gotten a lot of questions about money in the banks right now. With SVB going out, Silicon Valley Bank, a great big bank, and it went under, right? So how did it go under? Why did it go under?
What happened exactly?
So during COVID, the government gave out a lot of money to a lot of companies, and these companies weren't given instructions on how to pay it back or when they had to pay it back or what they had to do. So they were afraid to spend a lot of it. They put it in the bank. So the SVB's deposits went from 60 billion to 220 billion in a matter of 2 years. Now, when they have that much money, normally what they do is they lend it out, but there wasn't enough people to lend it out to. So what did they do? They put it in safe places like government bonds. Government bonds at that time were only paying 2%. So, but they were safe. Now, what was wrong with that? They didn't know the Fed was going to turn around and start raising interest rates like crazy, and now you can get government bonds at much higher rates. So what happens if I can get a government bond at 6%? Why would I buy a government bond at 2%? Well, they're stuck with these long-term government bonds. They had to get rid of them because it was on the balance sheet and it was dragging their balance sheet down. It was showing poor performance. So by regulations, they had to sell them and replace them. So what they were going to do is sell them and issue stock in order to recover the loss. And when they were doing that, one of the large companies that had money with them, because they're on the board and everything, they decided they're going to move some of their money out for safety reasons. Well, that got leaked somehow with some email and then some Twitter accounts, and it made everybody afraid, and that caused a run on the bank. A run is when everybody gets afraid and starts to take all their money out at the same time. So they had $42 billion requested to leave in the same day. They had money, but they didn't have liquidity, because to have that liquidity, they had to sell more bonds. And if they sell more bonds and more of a loss, it causes more problems. So can that happen to your insurance company? Since we deal a lot with safety and insurance, can that happen with insurance companies?
Well, we've gotten a lot of questions from clients lately about would this problem affect insurance companies? Because we've heard that it may affect other banks. Other banks have also bought bonds and are in similar issues.
And insurance companies buy bonds.
And insurance companies also buy bonds. So is there a difference? And if you have money in an annuity or in a life insurance policy that you have access to, it's likely not to be affected in the same way. And so here's why. Insurance companies, first of all, have different reserve requirements than banks. So they're required to keep more cash on hand compared to the bank. But more importantly than that, insurance companies are by their nature not 100% liquid all the time like a bank is. If you have money in the bank, you expect that any day you could walk in and drain the entire account, the checking account, the savings account, with no penalties. And so people do when there's a run on the bank. In the insurance company, if it's a life insurance policy, then you have fees and charges that are coming out. And surrender charges. If it's an annuity, you have surrender charges, surrender fees. You may or may not be paying an annual fee, but you probably have surrender charges if you liquidate the entire account within a certain period of time. And so the insurance company has that built-in protection for themselves and for you. So if you try to liquidate the account before a period of time is up, where the bonds that they had bought to support that, they're paying a certain interest rate, so you're getting your guarantees. But if they can't liquidate those bonds except at a loss, that fee is passed on to you. And that prevents you from just draining the whole account, but it also protects you from other people who may want to do that and cause a cascading effect on the insurance company.
Even if it happens, the insurance company has that fee to cover the losses.
Exactly.
So it can't happen the same way it happened to SVB.
And in fact, it can even benefit you in the opposite type of market environment. So if the interest rates had gone down instead of up, then SVB would have made a profit on those bonds, and they don't have to pass that along to the depositor. But in the insurance company, if you have an annuity with a market value adjustment, an MVA, and
sorry about that,
and the MVA is in your favor when the interest rates go down, your surrender charges are actually reduced, sometimes even close to zero, if the insurance company can sell those bonds without a loss or at a profit. And that allows you to have more liquidity in times that the insurance company can afford to give that to you.
So what you're saying, Daniel, is now as the rates are peaking, it might be a good time to look at annuities seriously, because you would have a much better market value adjustment going forward as the interest rates go down, right?
Exactly. And so if you want to meet with us and ask us specifically about how this applies to you, you can click the link in the description, and we'll be happy to meet with you one-on-one.